Welcome to AML classes. What is risk? And what are the different types of risk bank faces? Risk refers to the potential for loss or negative consequences resulting from various factors or events. In the context of banks, risk refers to the uncertainties and potential threats that can impact a bank's financial stability, operational efficiency, and reputation. Banks are exposed to several types of risks, and managing these risks effectively is crucial for their long-term success and sustainability. Some of the common risks banks face include credit risk. This is the risk of borrowers or counterparties failing to meet their financial obligations to the bank. It arises from lending money or extending credit to individuals, businesses, or other financial institutions. If borrowers default on their loans, the bank may suffer losses. Market risk. Market risk arises from changes in market conditions, such as fluctuations in interest rates, foreign exchange rates, commodity prices, and equity prices. These changes can impact the value of the bank's investments and trading activities. Liquidity risk. This risk refers to the possibility of a bank being unable to meet its short-term financial obligations when they come due. Insufficient liquidity can lead to a loss of confidence in the bank and may even result in a bank run. Operational risk. Operational risk arises from the potential failures in a bank's internal processes, systems, or human errors. It includes risks related to technology, fraud, legal and compliance issues, and other operational weaknesses. Reputational risk. This risk involves the potential damage to a bank's reputation due to negative public perception or actions that could harm its image. Reputational risk can lead to loss of customers, investors, and business opportunities. Compliance and regulatory risk. Banks operate in a highly regulated environment, and failure to comply with applicable laws and regulations can result in penalties, fines, or other legal consequences. Strategic risk. Strategic risk is the risk associated with the bank's business decisions, including the adoption of new technologies, entering new markets, or pursuing new business lines. Poor strategic choices can lead to financial losses and reduced competitiveness. Interest rate risk. This risk is specific to banks with significant exposure to interest-sensitive assets and liabilities. Fluctuations in interest rates can impact the bank's net interest income and the value of its assets and liabilities. Cybersecurity risk. As banks rely heavily on technology and digital systems, they are susceptible to cybersecurity threats, such as data breaches and cyber attacks, which can compromise customer information and disrupt operations. Country and sovereign risk. Banks that have international exposure face risks related to economic and political conditions in foreign countries, as well as the risk of default on loans to sovereign entities. Managing and mitigating these risks is a critical part of a bank's risk management framework. Banks employ various risk management strategies, including setting risk limits, diversifying their portfolios, conducting stress tests, and adhering to regulatory guidelines to ensure their stability and resilience in the face of uncertainties. Thanks for watching.